Do you want to know how to invest in stocks? Listen to Warren Buffett. Okay, bye. Thanks. Just kidding. I'm going to show you exactly how to invest in stocks in this video, particularly if you're a beginner. Hi, my name is Jessica. If you are new here, welcome to the channel. Consider subscribing if you haven't already done so. We talk all things money. I upload a new video every single Thursday sharing with you what I've learned on my own journey to financial independence. Let's take a step back and start at the beginning. What does it mean to invest in stocks? When you purchase stock of a company, you are buying a small piece of that company, which is what we call a share or shares. As that company grows, performs well, and grows over time, your shares become more valuable because other investors are willing to pay more. So as the company goes up in value, company's stock goes up in value, other investors find it more desirable, therefore they're willing to pay more. So your share as default goes up in value as well. Public companies issue stock to raise money so that they can invest back into the business so that they could grow their business. And investors buy stock to increase their money and increase their returns on investment. So it can be a win-win strategy if you do it right. So what do I mean by doing it right? This is where Warren Buffett comes in. There is some basic fundamental advice that Warren Buffett is known for. He often shares that advice. If you see any of his talks on YouTube or in books or articles, he sticks to the fundamentals and he's pretty vocal about what his beliefs are, and obviously it's served him well. So it will serve you well to heed that advice. So there are a few fundamentals before we get into the mechanics that you must remember if you're going to invest in the stock market. Number one, think long term. When you are going to invest in the stock market, always think long term, buy and hold. Warren Buffett is known to say, invest in great companies, invest in excellent companies, and you want to hold that stock. You want to hold those investments because those great companies that have great management, they have great products, so they're great companies, they're going to increase in value. So your shares, their stock is going to go up in value over time. And of course, the market goes up and down. That's just the nature of the market. But in the long term, you are going to be the winner if you stick to this long-term strategy. And this is where you really have to work on your mindset. Don't follow the herd. And Warren Buffett is famous for saying things like, whenever people run towards something, run away from it. And when people are running away from something, run towards it. And he is a seasoned investor. He knows what he's talking about. So he's referring to the stock market or particular companies in that example, in that saying. But you have to make sure that you're doing your homework, make sure that you have the right mindset. So just because the stock market's going up and down on a daily or weekly basis, don't sell. And the second thing you have to remember is to buy only what you understand. Don't go off on the hot tips that you hear out there. Make sure that you understand the company, make sure that you understand the product or whatever it is that you are thinking of investing in. Make sure you understand it. So for example, since we're talking about Warren Buffett, just look at his example back in 2000s or late 90s, early 2000s, when this whole tech thing was coming up in the market. He never invested in it, not because he's not smart, but he knew that he didn't understand it. So he only invested, he stuck to what he understood. So if you're willing to put in the time and understand certain things, great. Otherwise, stay away from, just because everybody else is doing it doesn't mean you should be doing it. Invest only in what you understand. And the third thing you need to remember is invest by facts, not by emotions. Essentially, it means do your homework, know what you're getting into, then don't get emotional about the ups and downs of the market. A lot of people, unfortunately, really get carried away with this just because if the market's taken a dip and you hear all sorts of things on television, unfortunately, the news and the financial media doesn't help. You hear all these sound bites, everybody's selling this, everybody's buying that. So a lot of people can get into this herd mentality and let their emotions get the best of them. So if you are following that long-term strategy, which is advice number one, if you are sticking to that long-term strategy, you know what you're doing, then you don't need to get caught up in the emotion. You just ride the wave. That's really the best way to deal with the stock market. You have to be able to ride the wave. Things go up, things come down, but in the long run, it gives you great returns. So all you have to do is look at the last 100-year history of the stock market. It's returned an average of 10%. And that's pretty good. I mean, of course, there are some years we've seen negative returns, and some year, like this past year, has been double digits, crazy returns, like 20%. And obviously, we know that that's not sustainable. That's not how it's always going to be. Some year you might see negative, 1%, negative 2%, whatever it is. But over time, if you are patient, it's going to average out for you, like the stock market has proven over its 100-year history that it's provided a solid 10% return. And the fourth thing you should remember is buy low. This is what Warren Buffett calls buying below a company's intrinsic value. Obviously, in order to do that, you really need to know what you're doing. You want to be able to do your homework. And, we can't really compare ourselves to Warren Buffett unless we're willing to spend that kind of time and effort on it. So you want to be able to do your homework. You want to be able to analyze certain things, analyze companies. All of this is particularly important if you're going to buy individual stocks. So just hold on for a few more minutes. I'm going to simplify all of this for you very, very much. It doesn't have to be as complicated. You don't have to be Warren Buffett. You don't have to sit there and analyze stocks for days on end. And there's a much simpler way, which I'm going to share with you. But I just wanted to put these basic mindset pieces out there because this is very, very important. A lot of times people get sucked into this sexiness of investing. And that's the last thing. That should be the last thing on your mind. Investing should be boring and not sexy and adventurous at all, because you don't want to be adventurous with your money. You want to understand the basics and fundamentals, which is what I just shared, those 4 pieces of advice. That's just the basic advice you always, always, always want to remember when you are investing your money. Remember, you're working hard for your money. You're working 8, 9, 10 hours a day, 40, 50 hours a week, an average person works. You work hard to bring in your money. You don't want to gamble it. If you do it right, investing in the stock market, it is, you're using history, you're using fundamentals, you are using analysis, you are using all of these tools at your disposal to invest and expect a certain return. It is not gambling. Unless you don't listen to that advice, right? Unless you don't listen to basic advice. So if you're investing in things you don't understand, you want to play the penny stock, you want to just be a day trader without really knowing anything about it. You want to buy stocks based on tips and then sell stock based on tips and then just let your emotions take the best of you. Now you're gambling. That is no longer investing. Now, if all of that sounded a little bit too much and a little bit intimidating to you, hang in. We're going to talk about the mechanics that will take a lot of the guesswork out for you. So let's talk mechanics. How can you invest in stocks? So there are 3 basic ways that you can invest in the stock market where you can have a piece of that return. So the first way is to invest in individual stocks. Which is where all of this advice that I just shared with you directly applies. So if you want to buy individual company stocks, let's say, Tesla is talk of the town these days. So let's say Tesla. If you decide that you want to invest in Tesla stock, so you have your account, your brokerage account, you go in and you purchase Tesla shares. And so now you pay so many hundreds of dollars, probably over $1,000 right now, per share. And you hold on to that and you're hoping that the company will continue to increase in value and you will get your returns. Unless you are a seasoned investor, I can't stress that enough. Unless you are a seasoned investor, you know what you're doing. You are willing to put a lot of time into researching the company, researching the management, and studying the financial reports, studying the company's quarterly and annual reports, and you're willing to do all of that and you're fairly confident, I don't recommend a beginner investor to do individual stocks, really, because it takes a lot of time and effort. And a lot of times, if you're first starting out, that will demotivate you, because just a sheer amount of work that's required, and then you may or may not do well depending on what companies you pick. So this can actually be a deterrent from investing, which would be a shame, because you really should be investing in stock market and making the most of your money and your investments. So unless you're seasoned, I would say investing in individual stocks might not be the best way to start. Maybe once you gain a little bit more confidence and you're willing to put a little bit more time in it, absolutely. Second way to invest in the stock market is mutual funds. Mutual funds are a mixture of stocks, bonds, and other securities. So they're inherently diversified because they're just all packaged together. Typically, a lot of mutual funds are active, meaning they are being managed by a fund manager. So the fees tend to be a lot higher because that manager, whoever manages that particular fund, obviously takes his cut or her cut. So mutual funds tend to be higher in fees. And that can get really expensive for you as the investor. And it's really difficult to beat the market. So I don't care what these managers say, it's very, very difficult to beat the market. And so to me, that's not the best strategy. But nonetheless, that's another way to invest in the stock market. And a third way to invest in the stock market is through index funds. Index fund is also a pool of investments, and it allows you to diversify right off the bat, just like mutual funds. Index funds and ETFs, they are kind of a mutual fund which tracks an index. It may track an index like S&P 500 or total US stock market or total Canadian stock market and things like that. The beauty of index funds is that they seek to mimic the market, not to beat the market. So there's no active fund managers, so the fees are really, really low, and they try to mimic the market. And a lot of times they perform even better than mutual funds. Even though there's no active fund manager, you're not paying any fees. So to me personally, index funds are really the way to go, not only for a beginner investor, for anybody. I'm a big fan of index funds because I don't think that it's very easy to beat the market. I mean, there are a handful of fund managers out there, hedge fund managers, who are really, really good at it, but they're literally a handful in the world. And a lot of times these managers who pretend to do the work to charge those fees, to me, are not really worth it. So index funds are a really good way to go. So you don't have to put a lot of time and effort like the individual stocks investing, because if you can buy, let's say, for example, S&P 500. So these are 500 curated companies that you're buying a stock in. So it's allowing you to purchase a little bit of so many different companies, in this case 500 different companies. And if that index does well, automatically you do well. And that's a much safer and diversified and a little bit of hands-off approach as well, which is not a bad thing, especially if you're not a seasoned investor. So clearly I'm a big fan of index funds, but nonetheless, those are the 3 different ways that you can invest in the stock market. Now, the final question for today is, how much should you invest? That largely depends on your income and your age. First things first though, first you have to make sure that you have enough money set aside in a sanity fund, or commonly known as emergency fund, so that you have 3 to 6 months worth of expenses saved somewhere liquid. So not invested in the stock market, because if you invest that in the stock market and you need it, and the stock market's down at the moment, you are going to lose a lot of money. So you want to have cash available for 3 to 6 months worth of expenses. It's just a great way to have a sense of sanity, so you can sleep peacefully at night knowing that you're covered for the next 3 to 6 months should you ever lose your job or should anything unfortunate happen. So that's the first order of business. So before you start investing in the stock market, make sure that you have 3 to 6 months of sanity fund. Second thing that you want to have available to you in terms of liquid cash is if you have any short-term expenses coming up. For example, let's say you want to buy a house next year and you're starting to save for your down payment. So you want to have that money available to you in cash. And if you have a child who's going off to college next year and you're gonna be paying their tuition. So those are the type of things, short-term things that you want to be able to fund with cash. So have that cash available on hand first, and then you start to put your money towards investing in the stock market. And you can use various accounts or vehicles to invest in the stock market as well. So if you already have a retirement account, whether it's your RSP or 401k if you're in the US, or TFSA in Canada, which is sort of the secondary retirement account, and in the US being the IRA or Roth IRA, though within those accounts, you can also purchase index funds or stocks or whichever of those three investments that speak to you the most. And if you've done all of that already, as I've said in previous videos, then you can open a brokerage account, which is above and beyond your retirement accounts. And the money that you put in there is post-tax, so you don't get a lot of tax benefit on that account, whereas you do in your retirement accounts. So that's kind of your last account that you would want to open once your retirement accounts are fully funded. So hopefully that makes sense to you. That is how to start investing in the stock market. And if you have any questions, be sure to leave them down below in the comment section. I would love to hear from you. Are you currently investing in stocks? How do you invest in stocks? Are you into index funds or are you into purchasing individual companies? I would love to hear from you. And thanks again for watching. Don't forget to hit the like button and the notification bell so you don't miss any upcoming videos. And I will see you in the next video. Thanks for watching.